Okay, so again, Tom Roseen, Head of Research Services. I'm going to be talking about the first quarter 2014 equity funds review. And overall, it was actually an okay a quarter. I'm going to show you later on that it was the seventh consecutive quarter that we've had plus side performance, although it was really quite stingy in the returns. You'll see this later on. But what I'd like to do is give us a kind of a presentation of what actually happened during the quarter and give you kind of a month by month review, and we don't have to go over that each and every time. Four basic themes that I think popped out at us was, first of all, as we finished up 2013 grand year, a lot of investors had not got into the party at that time, though. Really, 2013 flows into equity funds were really low. We saw a lot of people actually start picking up flows in this quarter, and even though we had some, again, lackluster returns, investors still were putting money back to work, and we think that's part of the reason the rally continued on. So even though we were expecting a near-term correction, again, investors kept us on a path of positive returns for the month. January certainly was not one of those months. In fact, we had one of the worst performances that we've seen for January returns. The S&P 500 saw the worst returns since 2010. And of course, as I have written up there, the Dow saw its worst returns, January returns, that is, since 2009. So that was a particular story. Another story that came up was the Fed's commitment to continuing tapering. And I think that put people off a little bit in January, and it's maybe one of the reasons we saw some of the lower returns that were out there. But what we did find out later on in February and March is that truly, to our friends at First Trust, you've been using this term, a plow horse economy. We certainly saw it as well. So while we've had some kind of discouraging news here and there, really most of the economic news has been fairly strong and gave us some fairly good news to hang our hats on and to continue forward. But as we got out of February, we had one other big thing affect us, and that was Russia's annexation of Crimea. And I think that was really put a lot of people back on their heels. It was maybe the black swan event that people were expecting to knock the market down. But after the ho-hum response from the West, no real particular negatives for Russia for what they were doing, people breathed a sigh of relief that there was not going to be any shots fired over this issue as well. So those were the kind of the four major themes that I think that drove the market. And one of the things that we can go back to is this concern of near-term corrections. And I think that's what actually set some of these returns off. We saw gold and dedicated short bias funds do better, obviously, in January, but then it continued on with gold doing better as well in February as well. So really, people were still very concerned, and even though we had 98% of all equities and mixed asset funds in February post plus side returns, we had a 4.65%, the S&P 500 up 4.31, another record set, multiple records set in February. We still had people sitting back saying, but really we don't know what's going on with Crimea, and we certainly still don't know what's going on with the Fed, with Fed Chair Janet Yellen taking the stage. People expected monetary policy to continue on as was dictated, but we also heard her later on say that as soon as we get done with the monetary easing of monetary, or taking away the easy money and monetary policy, that we could see interest rates rise as quick as 6 months, put people back on their heels again. So that was kind of the story. And again, I don't want to go through each one, but I do want to point out some trends that we saw here as well. First of all, we saw that in the beginning, January, February, we saw basically that Latin America emerging market funds were actually down to the bottom. We saw that gold up at the top, safe haven plays. But one of the interesting plays we're going to talk about later on is that we saw commodity agricultural funds. That's at CMA up 10.57% in February, and then again up then up again 4.44% in March, where it was really the play. I'll give you a story why that happened as well. And we also saw encouraging, by the way, I think encouraging. Economic data was soft, but encouraging plow horse numbers for our non-farm payrolls. So I think last 2 months things started to look better as well. So let's go ahead and actually take a quick look at what happened on a quarterly basis, kind of the big picture. Again, the seventh straight quarter of plus side returns. Sector equity funds were up for the first time that we've seen them in 17 quarters. They were the top performers, up 4.05%. Let's think back to what I was talking about. Gold actually did fairly well because people were concerned. It was a little safe haven play after it got knocked just to pieces in 2013. We also had that CMA, that's commodities agricultural funds, up 16.15%. So certainly very strong performers. But again, it was something that we hadn't seen for a while. Is the sector equity funds actually taking the top billing for a while. And one of the things that, again, what we were saying is that investors were really taking off. Keep in mind, fourth quarter 2013, 7.08% return was the average return for the group. So we had some top flyers that actually went down to the bottom. Japanese funds, they were down 4.45% for the quarter after having a grand year. A lot of people, basically wanted to step aside and see what the Abe government was going to be doing here in the future. So I think that's why we saw those go down. What we take a look at, the dollar actually gained just minutely against the euro, but declined against the pound and the yen. And commodity prices, as I was saying, were on the rise. So gold gained 6.78%. We'll keep that tucked in the back of our minds. And oil rose 3.21% for the quarter. So again, had we not had Janet Yellen spook us for a while there, I think we might have had maybe a little bit more robust numbers, but people were basically still concerned with Crimea. And again, one of the primary issues was the taking away the easy money from the Fed. So now we get to our United States diversified equity funds. And markets did generally shrug off the tensions between Russia and Ukraine, especially after our muted response to the Crimean vote that they would secede from the Ukraine and go to Russia. And I think that let some people back in the market, had people basically saying, hey, listen, maybe we had kind of a pullback. I don't know if it was a true correction. We didn't hit 10%, but it certainly was the ability to go back in. But what happened with this concern that was still on the table is investors did pull back, and they basically took money off the table for their big winners. So it was not unusual for us to see, and it certainly wasn't a shock for us to see large cap growth funds or any of the growth oriented funds you'll see here later on actually towards the bottom, while value and core oriented funds were at the top. People were looking for value and basically taking money off the table for their big growths, because we had a grand run up in tech and biotech, as well as we've talked about in prior quarters. This certainly kind of played through with our numbers. And as we take a look towards the month, basically we saw the large cap value funds for the first month in 37 actually as a top performers. So there's that value play I was talking about. And then we get down to the point where multi-cap growth funds, that was very popular classification for the first time in 17 months, at the very bottom. And that had a minus 2.34% return for the month. Let's take a quick look now at the table, and you can see where I've circled that basically this was value-oriented play. It's the first quarter in 5 that multi-cap value equity funds was at the top, so that was something different. But again, I think the main story here was that people were interested in value, and that certainly was loud and clear as we take a look at this chart. At the bottom of the barrel, we saw for the 7th consecutive quarter dedicated short bias funds, and by the way, it posted the worst return in the universe for equity funds. So certainly that was a continuation that we've been talking about for some time. Now, as we take a look at our 4x3 matrices for the quarter, we see that mid-cap funds for the first quarter in 5, basically the top performers, 2.09%. And then we also saw that the value funds were up 2.39. That's the second quarter in a row that they were top performers. And unlike in Q4 2013, which we witnessed no clear winner in the style group, Q1 really did show the difference. Basically value-oriented funds up 2.39%. We had core funds that were only up 1.75%, and then growth funds were only up 0.48%. So certainly value struck through and continues to be that story. As we take a look at the month, that same plan basically came through. For the first month in 6, we've seen that large cap funds went back to the top. So again, remember I was telling you there was a little bit of shyness away from growth and even large, because that was something that people gravitated towards. So they were pulling money off the table originally. So on a month-by-month basis, first month in 6 that we've seen large caps at the top, and they had to claw their way up to show that they could mitigate losses better than the other group. Of course, it was only a minute number. Now we take a look at the core growth of value for the month. Here's where that story comes through. Basically 1.62% for value funds, and this could have been a result of some positive news from the Fed that posted the stress test that they do on banks. I think it was 21 out of 22 passed the stress test, which was encouraging on the financial side. Certainly helped out as far as financials go. And if we take a look at the Lipper active indices, large cap value funds benefited from heavier weightings and relatively stronger performance from financial sector stocks. They had about a 0.75% portfolio contribution. Then we saw information technology and energy stocks coming in second, third with 0.36% and 0.35% portfolio contributions. So that was the story behind that as well. As we take a look at the sector equity funds, this is really kind of a non-busy slide, but there was certainly some busyness in it. Again, best first quarter and 14 quarters that basically we saw that the sector equity funds were at the top of the group. Again, if we keep in mind, this was one of last quarter's laggards. So it's the first time since we've seen, since Q4 2009. And at the top of the group, the two best performing classifications in the universe for the quarter were, again, commodity agricultural funds, and then we also saw that gold-oriented funds, up 12.21%, were basically the best performers of the group. Keep in mind, gold was at the bottom of the barrel last quarter, at the very bottom of the quarter. Here's what happened. We saw erratic weather in North and South America that wreaked havoc on harvesting fruits, coffee, oats, and also threatened planting season for soybeans and corn. So this was a very important issue, and it's why we've seen commodity prices just jump. I'm sure you guys have seen it at the supermarket as well. And we also, in January, had a virus breakout in 22 states that basically pushed hog prices skyward. So this was a pretty big deal as far as that. And then if we take a look at the precious metals concept, again, gold was up 6.7% for the quarter. It's maybe a little bit to do with the Fed spooking the market, as I was telling you about a little bit earlier. So that was kind of the story. If we take a look at the month, of March is basically the worst performer. It is down 0.37%. They were very tight in March, by the way. We're not talking about a whole percentage point between all four groups. But certainly this is where we see the idea that health and global health, that is the H and the GH at the bottom, performing probably the worst of the group, down 5.06% and 3.79% respectively. And this is off rumors. Basically, everybody said, hey, listen, biotech issues, we're entering bubble territory. And, the pundits were out there kind of knocking on the scare door again and just trying to get people rattled. They certainly did. And people turned around and said, hey, you know what, we're going to pull a little bit of money off the table. So they started doing a little profit taking. Through March, the one-year return for this group is up 36.97%. So again, I think we have some room to take some money off the table there, but certainly that was part of that story that came out loud and clear. Let's go ahead and move on to the actual chart. Here we can take a look and see that income payers and also out-of-favor issues were the top performers: commodity agriculture funds, precious metal funds, real estate funds, and utility funds, all at the top. If we take a look at the world equity funds, basically, we have the best and worst for this as well. So World Equity Funds posted the lowest returns for Lipper's four macro groups, and they were extremely helped by India this time. India region funds up 9.55% for the quarter. If you recall, last quarter we talked about the same thing. People were kind of looking forward to what was happening in the government, that there would be a governmental change. And here what we saw was that during the month, Indian stocks rallied as foreign direct investors poured about $2.5 billion into the Indian market. And this is really an optimism that the opposition BJP party might actually be able to form the next government, and this actually helped people feel that the new elections would be good for the economy, and they just plowed money into it, and certainly it was grand returns. Other than that, people were still being very focused for the quarter now for developed market type of funds. So we see international small cap value, we see international small cap growth, and that's small to mid cap, by the way, growth, being the next top two performers. And of course, as I was telling you, people are concerned with the Abe government, whether they're going to be able to follow through with some of their promises at the bottom of the barrel. And this was also, I think, exacerbated by, if we recall, the Nikkei lost by about 8.89 for the quarter. And this is basically due to political turmoil in the Ukraine and driving up the yen in a safe haven place. So there was two pieces there that I think drove Japan to the bottom of the barrel on the quarter. Now on the flip side, as we take a look at March, best performing group, again only 0.20% as far as returns go, but now we see India region, Latin American funds, emerging market funds at the top, basically making that impact. And I think that's probably a little bit what it was. People, while still concerned about China's GDP growth, we're also seeing some greater growth opportunities, and certainly made a change in trend from going from all developed to emerging markets. And maybe that was it. Maybe it was a little bit of baby with the bathwater, them buying back some of their securities in the emerging market arena. Let's go ahead and take a look at the 3 by 3 matrices that we have, and basically it was the same pattern we saw before. Basically, the small mid caps actually did very well, and then we also saw value-oriented funds doing well. We had at the top of the international group, international small mid cap value up 3.97%, and the global multi-cap value up 1.82%. And as we take a look again for the quarter, we have India region funds at the top. And as I said before, really developed market funds, in particular small and mid-cap value, kind of that out-of-favor group from prior quarters at the top. And of course, we do see European region funds. You know, we did get a good report earlier in the quarter that Europe was actually showing some pretty good GDP growth, and also we saw that Italy finally came out of its recession, out of a 2-year recession. That was certainly a big plus in that group. So let's go ahead and take a look at the last group that I always take a look at. We have the Q1 results for the mixed asset funds, and basically it was the second best performer of all the classifications for both the month of March and also for the quarter. And so Q1 we basically had 1.47%, and just for March 0.02. But of course, again, you guys saw some negatives in there as well. At the top of the barrel, we saw the top of the heap was basically convertible security funds up 3.12%. At the bottom for like the third quarter in a row, the alternative global macro funds down 0.37%. So really kind of a fairly tight range, and no real big losses to be had in the group, which I think is you see people breathing a sigh of relief on this. Let me give you a quick breakdown on why I've always brought up mixed asset funds. They've always been a big attractor of assets, and just this quarter they were surpassed by 2 of the other macro groups, or actually one of the other macro groups. So year to date we've seen, this is through February. Barry's going to tell you a little bit about through the whole quarter, but this is for mine through February 28th. We had $77.4 billion, this is ex-ETFs, coming into the equity community, right, as a whole. And how that broke out is world equity funds actually attracted more money. Again, remember I was telling you about they were at the bottom and the top during this piece that we're looking at. But $27.4 billion net new money. Mixed asset funds took in $18.8 billion, while their counterparts, the United States Diversified Equity Funds, actually took in $18.3. So mixed asset funds still were one of the top attractors, just following world equity funds. But certainly we're seeing investors actually willing to pad the mixed asset funds, the coffers of the mixed asset funds. But at the same time, they're starting to make more focused bets. So we're seeing more money roll into the world equity funds and also into USD funds in comparison. Here's my last piece. I'm going to go through it a little bit fast, but not too bad. You know, basically, here's my concerns. Earnings, because of the weather-related issues that everybody's been talking about, that is basically expected to be subdued. And what I believe to be happening is we're hopefully going to hear fair guidance from these firms about Q2 earnings. I think if you look at the Thomson Reuters proprietary research, are showing some pretty good growth rates towards the latter part of the year for S&P 500, and certainly that's going to be hopefully give us a tilt from guidance. But again, earnings I think are going to be subdued, and one of the reasons why we've already maybe seen that priced in the market and kind of a poor return for the quarter. ISM manufacturing index rose to 53.7 in March, and then the non-manufacturing increased to 53.1, but both were below expectations, and I think that's a concern for a lot of people. But again, I want to point out that both of those indices are basically in an expansionary phase, or showing their expansion, and a little bit discouraging though that they missed expectations. I guess the fundamental question is this a weather-related slowdown, or is it something more structural? I think that it'll kind of shake out in the next quarter. I believe that the Russia's annex over Crimea, and also the issues of China's growth rate, will be telling. And as we've seen it, tech biotech sell-off certainly has been there. Maybe that was put to the top after Facebook did WhatsApp for $19 billion. Maybe that was showing that we were a little frothy, and I don't know if we had a bubble there, but certainly that might have been an indicator that things were going way too well and they needed to have a little breather. Certainly that's what's happened. And what I'm positive about and feel good about it, in a speech to the Chicago Community Reinvestment Conference, basically we heard Fed Chair Yellen say that the recovery feels like a recession, and I think we can all believe that that means from her that the central bank will continue to provide extraordinary support for some time to come, and that was certainly positive. And even though non-farm payrolls missed expectations, I think they were calling for about 200,000 there, and we only ended up with 192. Certainly, it was a strong number, and again, back to the concept that First Trust Advisors, our friends there, basically we're talking a plow horse economy. That certainly supports that, along with February retail sales increasing 0.3%, in industrial production rising 0.6%. I think are all bode well for maybe a disappointing time period right now, but the second quarter I'm hoping doing much better. Well, I'm going to go ahead and hand this off. Thank you for time. Oh, and by the way, before I hand this off to Jeff, if you have any questions, please send them through. If they're pertinent to the conversation at the time, we'll stop and just answer it. If not, we'll take them at the end of the presentation as well. So I'm going to go ahead and hand off to Jeff.